All right, let's dive into a really fascinating story today. We're looking at Atul Ltd, a true giant in the Indian chemical space, 77 years old. And right now, it's facing a massive dilemma. On one hand, you've got a balance sheet that's built like a fortress. But on the other, its recent performance has just, well, it's taken a huge dive. So what's going on here?
Okay, first things first, our mandatory disclaimer. This report is a personal investment research note prepared solely for private use by Stressfree Investing. It does not constitute financial advice, a solicitation to buy or sell securities, or a SEBI-registered research report. The author may hold positions in the securities discussed. Past performance is not indicative of future results. All investment decisions involve risk. Please consult a SEBI-registered investment advisor before acting on any information herein.
So, this really boils down to one central question, doesn't it? Can this behemoth, with its absolutely rock-solid financials, actually pull itself out of this major multi-year slump? That's the conflict, that's the puzzle we're going to try and piece together today. To lay it all out, let's just look at the two sides of the coin. The bull case, the reason to be optimistic, is all about that fortress of a balance sheet. The bear case? Well, it's that complete collapse in profitability, specifically something called ROCE. The final verdict from our source is to accumulate, but, and this is a big but, with a 3 to 5 year time frame in mind. So let's unpack why. First up, part 1, the fortress balance sheet. Look, before we get into any of the problems, you have to understand the company's core strength. This is the bedrock of the entire positive case for Atul. Just look at these two numbers, a debt-to-equity ratio of 0.04x. I mean, come on, that's basically zero. The company is virtually debt-free. And as if that's not enough, it's sitting on a massive pile of cash and investments, over 1,700 crores. That is an incredible safety net. And the story of financial strength just keeps going. The interest coverage ratio is 29, meaning it earns 29 rupees for every 1 rupee of interest it has to pay. Super safe. The Altman Z-score, it's at 18.37, which basically means there is zero chance of bankruptcy. And maybe most importantly, you see a clean Banish M-score and zero promoter pledge. That tells you the books are clean and the insiders are confident. And hey, if you want just one number to wrap all that good news up, here it is, the Petrosky F-score. Think of this like a final report card for financial health. Atul gets an 8 out of 9. That's an A+. And it shows not just that the company is strong, but that its condition has been improving recently. So the key takeaway here, the foundation is incredibly, incredibly solid. But, and this is where the dilemma comes in, despite that fortress, there are some serious cracks that have appeared in its performance. So let's pivot to part 2 and tackle the risks head-on. And here is the first major red flag. Just look at the revenue growth over the past 5 years. Atul, it's managed only 6% annual growth. Now compare that to a competitor like PI Industries, which has been growing at 18%. In an industry that's growing, Atul has been lagging behind. Now, to really get the next slide, we need to understand a super important metric called ROCE, or Return on Capital Employed. It sounds complicated, but it's not. Just think of it like this. For every single rupee the company invests into its business, building factories, buying equipment, how much profit does it generate in return? It's the ultimate report card on how well a company invests its money. And this chart, wow, this is the heart of the problem right here. Back in 2020, Atul was an absolute star, generating a fantastic 28% ROCE. But then look what happened. It completely collapsed, all the way down to 9% by 2024. Now see that horizontal line at 14%? That's roughly what it costs the company to get money. When your ROCE drops below that line, you're actually destroying value. You're spending a rupee to earn less than a rupee back. It's recovering a bit, but it's still not where it needs to be. This quote really says it all, doesn't it? The whole investment case hinges on this one question. Can the company get its return back above its 14% cost of capital? If the answer is yes, the stock price could get a serious re-rating upwards. But if the answer is no, this could be a classic value trap, a cheap-looking stock that just stays cheap forever. So that brings us to part 3, the bet on a rebound. With such a big risk, why does the report still lean positive? Well, let's look at the catalysts that could spark a big recovery. So, the path to recovery seems to be a 4-step game plan. First, they need to start making money from all the huge investments they've made. Second, as sales start to grow again, something called operating leverage should kick in, which means profits will grow even faster than sales. Third, they need to get their profit margins back up from the recent lows. And fourth, they're expanding into new areas like water treatment, which could be a whole new growth engine. And what gives this whole rebound thesis a fighting chance is the business itself. It is not a one-trick pony. The company is nicely split between life science chemicals and performance chemicals. We're talking over 900 products sold in 88 different countries. That kind of diversification gives it an incredible amount of stability and resilience. It's a huge advantage when times get tough. So that brings us to the final piece of the puzzle, part 4. We've got a super strong company with some really poor recent performance. So at today's price, is it a bargain? Let's see. This slide lays out the possibilities really well. In the bear case, if things stay bad or get worse, the potential downside is about 17%. In the base case, which is the most likely scenario with a decent recovery, the upside is around 24%. And in the bull case, if everything goes right and the recovery is strong, you could be looking at a potential return of over 50%. This one number really sums up the whole valuation argument. If you take that potential upside from the base case and divide it by the potential downside from the bear case, you get a ratio of about 1.4. This means the potential reward is clearly higher than the potential risk, and that's exactly the kind of asymmetry investors love to see. And so we land at the final verdict from the report. Accumulate. It's not being called a screaming deep value bargain. Instead, it's seen as a very high quality company that's available at a fair price. But the key thing to remember is the timeline. This is a bet on a 3 to 5 year recovery. And so we end right back where we started. Will this 77-year-old giant finally manage to turn its massive investments into real growth and profit, or will it continue to struggle with poor returns, making it a classic value trap? The next few years are really going to tell the whole story. The full report is in the description. Like and subscribe if you want more deep dives like this. Most importantly, which stock should I look at next? Let me know in the comments. Signing off Stress-Free Investing for now. If you like this report, I am sure you will also like report on Hero Motocorp and other stock analysis as well, in my playlist named as Stock Specific Analysis.